Let us see something about weighted average cost of capital, and this would be under, uh, let's go to corporate issuers. I think it's in part 2, cost of capital, and this is reading 30, LOS 30A, weighted average cost of capital, abbreviated as WACC. We do have some notes as well as videos, but the focus right now is on the solved example. The problem is completely solved, but I'm going to solve this anyway. If you'd like to go through the problem statement, you can pause the video and read the problem very carefully. Pressvalley.com is one of the undertakings of our company, has 80 millions of equity and $60 million of debt. In the past, it has acquired debt at 8%, and the area in which the jurisdiction in which it operates has a tax rate of 35%. Its beta is 1.35. Current risk-free rate is 7%. Market portfolio has expected return of 13%, and the company's WACC is closest to. And then first we'll see some basic underlying concepts. It's a nice way to get revise. So when a company raises a capital, it can come into two forms. It can come as a debt, and or it can be in terms of equity. And the total cost of capital has to be weighted average. That means the proportion of debt and equity may not be half and half. It can be some random fraction between 0 and 1. So whatever is the weight of debt multiplied by its cost plus whatever is the weight of equity times its cost should give you weighted average cost of capital. So let's assume that the debt has proportion as WD and equity has proportion of WE. These are the individual weightages between 0 and 1. And the cost of debt is RD and cost of equity is RE. So if you take the weighted average of these two, that should be the cost of capital, ideally speaking. However, there is a small difference. The debt is often tax-free. So that means the after-tax cost, in order to get that, we have to multiply by 1 minus T. And that should be the final cost of capital. Again, in equity, you can have preferred stock as well as common stock, but this is the generic formula. So let's see in the context of current problem, how we can solve this one. How we can calculate the fractions? Well, if debt is $60 million and equity is $80 million, so the fraction of debt will be, so this will be 60 divided by 60 plus 80. I'm talking about only WD. And its counterpart here will be 80 divided by 60 plus 80. So this should give you the fraction only. Now the weight of debt has been calculated. Now the cost of debt has been directly given as 8%. Let us keep it as a percentage. And 1 minus tax rate is given as 35%. So since we are using 1, not 100, so this has to be 0.35. And the cost of equity, the cost of equity has not been directly given. It has been given indirectly. So technically, we are almost set, except the fact that we do not know the cost of equity. And for that, I'm going to switch over a little bit to capital asset pricing model. And let's assume, for this cost of equity, I'm going to draw a graph. This graph is market return and then equity return. And I'm going to start with this particular point on y-axis. This is your risk-free rate, which you normally get from government bonds. As the market return increases, the expectations of equity also increases. So there is a straight line like this one. If for the time being, let's assume that this equity is index fund or well diversified uh, mutual fund. So in that case, it will almost follow the market. And let's assume that this is indicated by beta equal to 1. Because it's so diversified, it almost follows the market. Now, what is beta? Beta is actually the multiplier for the excess return. Now, if you talk about the excess return, I'm going to draw a horizontal line. So this is your risk-free return. And from this point onwards is your excess return, which is market minus risk-free. So if beta is equal to 1, you get this straight line. Now, individual stock need not be exactly following the market. They can be less or more volatile. So this beta is a measure of volatility. And let me change the color. Let's say a certain stock can have beta equal to greater than 1. So it will be more volatile. In the case of good times, it will give you good returns. In the case of bad times, it will give you more losses. Technology stocks, startups, they are more susceptible for market fluctuations, insider tips, outsider events, and they tend to be more fluctuating, more volatile as compared to generic market. You can have the other case also. For example, let me change the color, and then this is beta less than 1. Certain stocks related to daily necessities, groceries, food related or generic transportation, they do not move as volatile as generic market because they are bound by human necessities. So there is a chance that their beta is less than 1. So beta is an indication of market volatility compared to the generic market, individual stock volatility compared to market. And because of that, we always get beta multiplier of the excess return. So the cost of equity, change the color, the cost of equity is always the guaranteed risk-free return plus a certain multiplier, which is beta, of the excess return. So now we can calculate this one. Uh, Even though the return on equity is not directly given, we have been given beta, which is 1.35. Market return has 13%. Risk-free return has been given as 7%. And then we can easily calculate out. Actually, in fact, this problem is completely solved. I can refer some of the values here, and that comes out to be 10.858%. Now, this was the only thing remaining in this formula here. And now I can substitute this value and I can get the final answer. Sorry, this is 15 point, my mistake. This is 15.1%, and this value goes here. And if you plug in those numbers, the final answer should come out to be 10.858%. That's all for the timing. Thank you very much.